the reason for spot broadly going up, spot Bitcoin, is ETF anticipation, right? You can feel it. You could feel it even over the weekend. You could feel it last week. There was obviously the head fake with the fake news story last Monday, but which I think really showed a lot. I mean, a lot of people in the traditional world, more traditional world counterparties that we trade with, were caught off guard by how violent the move was on that headline. And again, this is a headline that was not true. It wasn't the actual approval. It was had the underlying story been true, it still came from a crypto native, right? It wasn't like it was, Bloomberg reporting it, right? So, and it's still Bitcoin jumped 8% in 15 seconds, right? 15 minutes, right? And I think that caught a lot of people off guard. So broadly, the reason for spot going up obviously is around this ETF anticipation. I think a lot of people are realizing it's closer, and now you start to see the market repricing the likelihood of the ETF approval.
Alex Thorn is head of firm-wide research at Galaxy Digital. At Galaxy, Alex leads a team of researchers dedicated to understanding and unpacking developments in the cryptocurrency ecosystem, producing insights for internal and external audiences. Alex shares his bullish outlook regarding the Bitcoin ETFs, which have become the talk of the crypto community. He also shares predictions from Galaxy, who also have filed for a spot Bitcoin ETF. Another big shot in the crypto and financial world, Michael Novogratz reiterated that he expects the U.S. Securities and Exchange Commission will finally approve exchange-traded funds that invest directly in Bitcoin this year. While he anticipates the regulator to sign off in December, any Bitcoin ETF won't likely start trading until 2024, Novogratz, the founder and chief executive officer of Galaxy Digital Holdings Limited, said in Dubai at the AIM Summit Conference. Let us now get into the video and hear what Alex has to say. Also, make sure to hit the like button, subscribe, and drop your comments as you watch.
Retail has had access before institutions, right? And that's true. That's broadly true. And I think that's great. So everyday folks, you and I, as individuals, we can go and buy, Bitcoin at Coinbase or at Cash App or all these places nowadays, right? But investors, whether that's institutions or retail investors who have a third party, for example, manage their assets like a financial advisor or wealth manager, they don't really have in those channels a good way to access Bitcoin exposure. So in particular, the one that really doesn't, so you can still, if you go and sign an over-the-counter trading agreement at your Fidelity account, maybe you can buy some of the over-the-counter trusts, right? But it does require an additional agreement. It's not literally right there. You have the cash-settled futures, but they have roll cost and they succumb to decay, which makes them actually quite poor for longer-term investing. They're not bad for shorter-term stuff, but if you think about financial advisors, they're not trying to, many of these advisors may, oversee the portfolios of 10, 20, 50, 100 clients at the same time, right? So they're not going to be actively, these are much more about modeling and then maybe rebalancing or moving, changing your secular or cyclical view and then adjusting all the portfolios, right? You really can't be day trading the Bitcoin cash settled futures ETF. And that's what we look at. And primarily when I think about why it's such an important product, a spot-based Bitcoin ETF, I think primarily about accessibility, right? And these things broadly are sometimes called market access vehicles. And it really is, in my view, the wealth management channel that really doesn't have a way to show their clients Bitcoin exposure in portfolios. Some of these managers, right, they're affiliated with banks or broker-dealers, right? So we call them the bank BD platforms. Those are your big Wall Street banks, right? If there's a financial advisors that the people have that are at these banks, they are relying upon the bank or broker-dealer's platform decisions and approvals of investment products that can be offered to then the end clients through these financial advisors. So in some cases, they may not add a product because it's not suitable, it's too costly, it's I don't know, risky, who knows what. Some of them don't have cannabis ETFs because they just don't believe in giving people access to that. It's totally fine, right? But they're beholden to what the platform decides. And none of them that I'm aware of allow, for example, the cash settled futures ETFs or the over-the-counter trust, except for in specific exceptions. Literally you'd have to agitate and go get an exception, right? And then maybe they'd allow it because the client wants it. And if it's enough, maybe they'll do it. So that accessibility issue is very much solved with an ETF, right? Because the ETFs are incredibly brilliant and impactful financial products in general. They've overhauled how retail and advisors invest in the markets. They're great wrappers. They can access, they function effectively as if they're just a standalone security, but of course they can be an index, they can be actively managed or passively managed. They're kind of like a mutual fund with instant liquidity instead of like daily redemptions, right? So they're really
Yeah.
great products, and they're everywhere. So to me, like that's the main issue. And if you can think about it, like financial advisors also, they don't put their clients into cash settled futures derivatives based ETFs, right? Like they might put them in like a gold backed ETF because it's gold, right? Like they or commodity covering ETF. But again, like they need a relatively low fee, a safe, an accessible vehicle. Like that's
Right.
what these ETFs will be.
Issuance of new exchange-traded funds, ETFs, in the U.S. marketplace is on track to hit a record high in 2023 as asset managers rush to launch actively managed funds in response to rising interest rates and market volatility. As of last week, Morningstar Direct calculated that 391 new ETFs had begun trading in 2023. That's significantly higher than the 311 that had debuted by the final week of October 2021. The year ETF launches set a record of 475. Last month, ETF debuts set a monthly record of 69. So far in October, the total stands at 47, according to Morningstar Direct data. The final number for October will almost certainly be higher, analysts said. Most of the trends that have fueled explosive ETF growth in recent years are expected to remain intact heading into 2024. When asked about his projections for the inflow into ETFs, here's what he had to say.
The top line numbers that people are taking from this, and I'll just state those briefly, which is that we think there'll be 14.5 billion in inflows year one of an ETF, ultimately going to like 38 billion in year three. So not cumulative, like 38 billion of inflows in year three. That is intended to effectively be a lower bound and I'll tell you why. It's based on the assumptions and the total addressable market that we're capturing. But first, the TAM, right? So we're starting with this top line number, which is the wealth channel. That's why I talked about it before. Again, we have some discussion about accessibility and why we think that's the segment or channel that will benefit most directly from the creation of this product. Because again, we can go buy Bitcoin right now. I could pull out my phone, beep, beep, buy Bitcoin, right? But, like people with wealth, like have wealth managers, and they don't like just also separately manage a different Bitcoin position out here in some app, right? Like they need their advisor to have everything right there, right? So for Bitcoin to be adopted in those portfolios, or even considered for adoption in those portfolios, it has to be sitting there adjacent as an option, right? And it's that channel that I described earlier that doesn't have it. That's a $47 trillion market in the US of AUM. And we broke it down. So it's $27 trillion at broker-dealers, 11.9 at banks, and 9.3 what we call RIAs, registered investment advisors. These are all the advisors on these platforms are RIAs, but what we mean by that are independent investment advisors. These are advisors who are not affiliated with the broker-dealer or bank, but and most likely they use like Fidelity, Pershing, Schwab. All of those brokerages have white label-ish platforms that make it easy for an advisor to manage multiple sub accounts and all that. So they're at those places. And that comes out to what, I guess 48.3 trillion is what I'm looking at. So not 47, but right around there, right? So that's a big possible number, right? And then we start looking at the list of broker dealers, banks, and RIAs sorted by size. So we didn't look at literally everyone. There's a lot of them, right? But like we looked at like all the big ones, and then we started handicapping how quickly we think they would add support for the ETF. So for example, those independent RIA platforms like Fidelity has, right, where I worked for 12 years. So I know a little bit, I remember this platform. They're probably going to add it pretty fast. This is not a thing where Fidelity.
For sure, Fidelity.
Yeah, I know, true. Yeah, they almost certainly will. But those platforms do not, it's not the same level of approval. They don't care that much what the RIAs invest in the scheme of things, not nearly as much as those that are literally affiliated with the bank's platform, right? Like they walk around with like I don't want to name any banks, that's why I haven't said any, but like the big banks, they all have wealth management divisions, and those financial advisors, they work at the bank, right? And the platform is run by the bank. So like they take suitability questions in much more carefully. Like I said, they have to approve and decide what products can even potentially be offered by their whole advisor universe, right? So they'll be slower to adopt the banks and broker dealers than the independents, right? So what we did is we started with, like a ramp up in terms of what of that AUM in each channel is going to become addressable on each year, right? So we said only 25% of the broker dealers and banks AUM. I mean, we don't know the number of accounts, but we'll just use AUM as the total like sort of addressable capital market. only 25% will actually turn on the ability to add the ETF into a portfolio on their platform in year one, right? So that now brings down the total addressable market. So we're no longer at, for example, for broker dealers, we're no longer at 27 trillion. We're at 6.8 trillion of addressable capital in year one, right? So, and we did that for each of them. And you can see there's a graphic in the report that shows this ramp for each of the segments, right? But we said 50% of the IRA capital will be addressable because it's at places like Fidelity and Schwab and Pershing. And honestly, not only will they have the Bitcoin ETF, they'll probably have all of them if they're all approved. Whereas even the banks and broker dealers, it's possible that, let's say they're all approved or whatever, all 9 or 12 or however many there are,
12.
they probably won't add support for all of them, even if they choose to add support. So only a couple may get through, right? Because they're like, that's enough. Like, what do we need to add 12? Like,
The U.S. government on Friday published an application by crypto giant Grayscale to launch an Ether ETF for the spot market. Grayscale first applied for the ETF in early October, but the petition's appearance at the Federal Reserve is significant because it starts a 240-day clock by which the Securities and Exchange Commission must respond. The start of the Ether ETF process also coincides with a surge in crypto prices this month that analysts believe is correlated to impending decisions by the SEC on a batch of Bitcoin ETF applications by Grayscale, BlackRock, and others. Since the start of October, Bitcoin prices have jumped around 27%, while Ether has climbed 7%. Many in the crypto industry believe the approval of ETF products, which make it easy for retail investors to buy various assets in the form of shares, will result in a flood of new liquidity into the markets. While Grayscale has sought to launch a Bitcoin ETF for years, the SEC has rebuffed these efforts, leading the company to sue the agency last year. In late August, a 3-judge panel of the U.S. Court of Appeals issued a unanimous and resounding decision that opened the door to widespread expectations that the SEC would issue an approval soon. Many industry watchers have circled early January for when the SEC is likely to approve, in part because that will coincide with another shot clock deadline for a Bitcoin ETF application by the crypto hedge fund ARK Invest. While ARK is currently at the head of the approval queue, it remains to be seen if the SEC will approve its application first or instead approve a larger batch of applicants all at once. It's also possible, though unlikely, that the agency will find a new pretext to delay or not approve the Bitcoin ETF applications. The process has been slow and convoluted in part because it involves a 2-part approval, one to permit exchanges to list crypto ETFs and a separate one for individual companies to issue the ETFs. In a quirk of the regulatory process, the SEC has approved futures ETFs for both Bitcoin and Ether. While these are also crypto ETFs, the underlying assets they contain are not digital assets, but instead futures contracts that are well understood only by investors well-versed in derivatives. With just 2 months left in 2023, do you think the ETFs would be approved this year, or do we have to wait until next year? Share your thoughts in the comment section below, and don't forget to drop a like, subscribe, and turn on notifications. Thanks for watching.